All right, let's dive right in. Today, in this explainer, we are going to decode the logic behind Peter Lynch. We're talking about a highly rational yet incredibly accessible framework built by a legendary stock picker. We're going to break down exactly how everyday, routine observations were used to build one of the absolute greatest track records in Wall Street history. To really understand why Peter Lynch is so revered in the finance world, you honestly just have to look at this one number, 29.2%. From 1977 to 1990, Lynch managed the Fidelity Magellan Fund, and during that tenure, he took the fund's assets from a modest $20 million to a staggering $14 billion. Achieving an average annual return of 29.2% over a 13-year stretch, that is almost unheard of. It means he nearly doubled the performance of the S&P 500 during that exact same time period. But okay, here is the really shocking twist to that success story. Despite Lynch generating nearly 30% annually, the average investor in his very same fund only made about 7% over that same 13-year period. Just let that sink in for a second. The fund makes 29%, but the everyday person actually invested in it, they take home just 7%.
So what gives? Why the massive gap in returns? Well, it turns out this performance gap was driven entirely by poorly timed investor behavior. The data shows that capital flowed out of the Magellan Fund during short-term market setbacks, basically when investors got spooked, and inexplicably flowed back in way too late, only after the market had already recovered. It highlights this major behavioral mystery in investing. Even when you are riding with literally the best fund manager in the world, panic and impatience will absolutely destroy your returns.
To empower the everyday investor against this kind of panic, and, against the insanely complex institutional models of Wall Street, Lynch championed a radically simple philosophy based on Occam's razor. His famous mantra was, invest in what you know. He firmly believed that you, the individual, actually have a massive advantage over institutional fund managers. By just keeping your eyes open and observing the businesses whose products and services you use in your daily life, you can spot massive growth stories long before the analysts in New York even wake up to them.
And this is how he executed that philosophy. It's all about bottom-up fundamental analysis. That means researching the actual strengths, products, and financials of individual companies. He completely unapologetically ignored top-down macro analysis. He wasn't sitting around trying to predict complex economic cycles or interest rate shifts or what the Federal Reserve was going to do next week. He believed that if you just pick a genuinely great company, the macroeconomy will sort itself out over time.
Moving from overarching philosophy to on-the-ground strategy, Lynch knew you can't treat the stock market as a single uniform entity. To define his expectations, he systematically sorted companies into specific groups.
He classified them into 6 distinct categories. First, you've got your slow growers and stalwarts. These are your massive, mature companies that offer a reliable 10 to 12% growth and give you crucial recession protection. Then you have your fast growers, smaller, aggressive enterprises growing at 20% or more. These are the ones capable of generating those crazy 10 to 40-bagger returns. Finally, you have cyclicals that ebb and flow with the broader economy, turnarounds, which are distressed companies that just might bounce back, and asset plays, where the broader market is somehow completely ignoring valuable hidden assets like real estate or cash. Nailing down the category is the absolute first step in knowing what to expect from a stock. But look, knowing the category isn't enough on its own. You still have to evaluate the financials. And to do this properly, Lynch effectively fused the principles of 2 very different worlds: value investing, which is looking for cheap stocks the market is ignoring, and growth investing, which is buying companies expanding at a rapid pace. By combining these 2 mindsets, he created a highly effective hybrid strategy. In the financial world, this hybrid system is known as growth at a reasonable price, or GARP for short. The core idea here is pretty simple. A pure growth investor might happily pay 50 or 60 times earnings for a fast-growing tech stock. But a GARP investor like Lynch looks at that exact same high-flying stock and says, sure, it's growing, but I'm not paying that much money for that much uncertainty. GARP ensures you find companies with solid, sustainable growth, but you demand a reasonable valuation so you don't overpay for that future expansion. Because ultimately, overpaying is exactly what kills your long-term compounding.
The absolute most crucial metric for a GARP investor to understand is the PEG ratio. The PEG ratio gauges the balance between a stock's price-to-earnings ratio and its actual earnings growth rate. For a true Peter Lynch strategy, this ratio needs to be kept strictly below 1 and ideally closer to 0.5. If the PEG is less than 1, it implies the stock's price is fundamentally lower than it should be given how fast it's growing. It's kind of like buying a high-performance sports car for the price of a used sedan. It is a massive green light that a stock is truly undervalued.
Now, Lynch didn't just go on gut feeling. he rigorously tested his qualitative everyday observations with a strict 5-step mathematical engine to ensure a company was actually healthy. Think of it as a financial health check for your own portfolio. First up, check the balance sheet. Debt must be under 25% of assets, and net cash per share must beat the industry average. Next, check the cash. Price to free cash flow must be lower than its peers. Fourth, check the warehouse. Inventory growth has to be slower than revenue growth, meaning they are actually selling their products, not just piling them up in the back room. And finally, the GARP score.
So what exactly goes into that final step? Calculating the GARP score is straightforward. You take the company's one-year average earnings per share growth, add the dividend yield, and then divide that total by the PE ratio. Lynch strictly required a GARP score of 2 or higher. If a company hits a 2, it acts as your mathematical confirmation that the growth is priced at a highly reasonable valuation. Most importantly, running this math takes the emotion right out of the purchase, which, as we saw earlier with those Magellan Fund investors, is the exact behavior you need to master if you want to avoid panic selling.
And the really beautiful thing about all this, the logic actually works in modern markets. A recent rigorous backtest applied these exact Peter Lynch GARP filters to the Taiwan stock market from January 2018 all the way to April 2025. The result? The Lynch-inspired strategy generated an annualized return of 15.5%, consistently outperforming the broader market benchmark of 13.5%. It just proves that combining growth characteristics with strict valuation limits stands the test of time no matter where in the world you're investing.
But all right, here is the reality check. Even the best mathematical screens and the most logically sound GARP frameworks require immense human patience. All the math in the world isn't going to save you if you lose your nerve the second the overall market enters a period of severe, irrational panic.
Consider the terrifying environment of the 1987 crash, Black Monday. The market had been on an absolute tear, rising from 777 in 1982 all the way to 2,700 by August 1987. But then in October, the market dropped 1,000 points, just a massive percentage of its total value vanishing into thin air overnight. Lynch's Magellan Fund lost nearly a third of its value in just 2 days. It was so severe and so sudden that Lynch actually had to cut his vacation short to deal with the fallout.
So what did he do? Did he panic? Nope. Instead of selling alongside the terrified masses, Lynch calmly looked at the bottom-up fundamentals of the companies he owned. He realized that while the stock prices were literally crashing, the actual corporate profits of his companies remained entirely healthy. The businesses were fine. It was just the stock market that was broken. He famously noted that while recessions are absolutely inevitable, investors should only worry when corporate profits go to hell. This proved once and for all that underlying business fundamentals matter far, far more than temporary market hysteria.
So the final takeaway for you to ponder today is this. The greatest stock picker of a generation built his massive success not on complex macroeconomic predictions, but on simple, everyday observation combined with disciplined math. Are you actively using your own local knowledge to spot the next massive growth story hiding in plain sight? Because if Peter Lynch's logic proves anything, it's that the best investment opportunities might just be sitting right in front of you.